The number hangs in the air, a ghost echoing through the deserted trading floors of Tokyo and Silicon Valley. $100 billion. It was supposed to be the ultimate demonstration of technological foresight, the fund that would own the future. Masayoshi Son, the visionary founder of SoftBank, stood astride the global tech scene like a titan, wielding capital others couldn't even dream of touching. He promised returns that defied gravity, underwriting companies that had yet to turn a meaningful profit, all based on the seductive promise of hyper-growth. But then, the gravity returned. Not gently, but with the force of a meteor strike. We see the wreckage now. Abandoned offices, panicked layoffs, and billions evaporating into the digital ether. The fall wasn't gradual, it was a sudden, catastrophic implosion. The whispers turned to shouts. Had Son gambled too much? Had the king of tech investment actually built an empire on quicksand? This wasn't just a correction, this was the sound of a meticulously crafted dream shattering. The Vision Fund, designed to reshape industries through sheer force of cash, was now bleeding red. The question isn't just how this much money was lost, but why the world's most celebrated investor couldn't see the cliff edge until he was already falling off it. Because when the dust settled on SoftBank's ledger in 2022, the sheer scale of the losses was breathtaking, marking the end of an era defined by relentless, often reckless, spending. But before the crash, there was the ride. A period of unmatched access and dizzying ambition that pulled the entire investment world into its orbit. How does one man, backed by sovereign wealth, convince the world that burning cash today guarantees dominance tomorrow? And more importantly, what happens when the flames go out? The story of SoftBank's Vision Fund is not just about venture capital. It's a cautionary tale about hubris writ large, fueled by unprecedented market conditions and the sheer magnetic force of a singular, charismatic leader. We begin at the precipice, just as the market was realizing that the future Masayoshi Son bought was suddenly unaffordable. To understand the implosion, you must first understand the architect, Masayoshi Son. Born in Seigan, Saga Prefecture, Japan, Son was always an outlier. He left Japan for Berkeley in the 1980s, armed with an intense curiosity and a legendary early coup, securing the US distribution rights for the revolutionary video game Pac-Man in Japan, a deal that reportedly netted him his first significant capital. But it was the 1990s that truly forged the myth. In 2000, Son made arguably the most famous early-stage investment in history, backing a fledgling search engine company called Google for $12 million. That stake, eventually worth tens of billions, established SoftBank not just as a telecom giant in Japan, but as a venture capital powerhouse capable of identifying paradigm shifts. This success afforded Masayoshi Son a specific kind of currency: unassailable credibility. By the mid-2010s, capital flowed into SoftBank, largely due to a crucial partnership with Saudi Arabia's Public Investment Fund, PIF, led by Crown Prince Mohammed bin Salman. This relationship was the key that unlocked the vault. In 2016, Son announced the creation of the SoftBank Vision Fund, a staggering $100 billion fund dedicated exclusively to chasing the next generation of disruptive technology: AI, IoT, fintech, and the digital transformation of everything. This wasn't traditional venture capital, it was kingdom capital, deployed with military precision and zero patience for slow returns. Son often boasted about his 300-year plan, a vision where SoftBank would own controlling stakes in the world's leading technology platforms. The fund's sheer size dwarfed every other VC fund in history, allowing Son to dictate terms, create artificial scarcity, and inflate valuations across the entire private market landscape. Competitors, established firms like Sequoia and Andreessen Horowitz, found themselves marginalized, unable to compete with the sheer, overwhelming firepower of the Vision Fund. David Ebersman, the CFO, and Rajiv Misra, the often controversial head of the fund's operations, were the lieutenants tasked with executing this aggressive strategy. Their mandate was clear: find companies disrupting massive markets and inject capital so quickly that they achieved market dominance before incumbents could react. The premise was elegant: if you own the future market leader in ride-sharing, satellite connectivity, or shared workspace, the monopoly profits will justify any initial price tag. This mindset created an investment fever, pushing the valuations of startups like Uber, ByteDance, TikTok's parent company, and countless others into the stratosphere, creating a gold rush driven entirely by the certainty of SoftBank's checkbook. But such unprecedented ambition carries unprecedented risk, and the foundation of this behemoth was built not on proven revenue, but on the intoxicating belief in Masayoshi Son's vision. A belief so potent it temporarily warped the realities of traditional business valuation models. The question remained: could this speculative edifice withstand even the slightest tremor in the global economy? The rise of the Vision Fund was less an organic growth and more a financial shockwave. From 2017 through 2019, SoftBank deployed capital at a speed that redefined the meaning of aggressive investing. Their thesis wasn't about incremental gains, it was about market capture. The sheer volume of deals was staggering. They poured $7.7 billion into Uber, buying a massive stake and effectively forcing a détente between the ride-sharing giants, showcasing their ability to mediate industry consolidation. They were early believers in ByteDance, injecting significant funds that helped catapult TikTok onto the global stage, a decision that, in retrospect, provided the fund with its most valuable, albeit politically complicated, asset. One of the most emblematic, and ultimately destructive, investments was WeWork. Under Son's relentless encouragement, and despite numerous internal red flags reported by employees and analysts, SoftBank poured over $18.5 billion into the shared workspace provider. Son saw Adam Neumann not as a CEO running a glorified real estate business, but as the messianic figure ready to tokenize community and space. A true AI-enabled ecosystem, as he reportedly described it. This support fueled WeWork's valuation to an almost absurd peak of $47 billion in January 2019. A valuation driven almost entirely by the certainty that SoftBank would back it indefinitely. The fund established a culture where valuation milestones, not profitability milestones, were the key metrics of success. They invested in everything that sounded futuristic. $2.2 billion in semiconductor designer arm, which they later had to sell and then repurchase, billions in satellite broadband provider OneWeb, and countless others in food delivery, robotics, and health tech. At its zenith, the Vision Fund reportedly held stakes in over 80 companies, effectively becoming the world's largest private technology portfolio. Rajiv Misra, leading the charge on deal flow, managed to convince founders worldwide that SoftBank was not just a source of funding, but a strategic validator. If SoftBank believed in you, the rest of the world was obligated to follow. This influx of unprecedented capital distorted the entire private equity market, forcing founders to hold out for astronomical valuations simply because they knew a competitor might receive a higher offer from SoftBank the next week. This era was characterized by immense confidence, best illustrated by Masayoshi Son's famed vision presentation slides, filled with complex diagrams showcasing overlapping technological revolutions, all converging on SoftBank as the central nexus. They operated with the conviction that conventional economic rules, like the need for positive cash flow, were constraints only applicable to lesser mortals. The fund's assets under management swelled past $100 billion, papering over underlying structural weaknesses with mountains of freshly printed valuations. They had successfully manufactured a perceived reality where high growth, subsidized by nearly limitless capital, was the only metric that mattered. However, this dependency on perpetual capital injection meant that any disruption to the global funding environment would instantly expose the fragile foundation upon which this paper empire stood. The fuse was lit, and the fuse was connected directly to the global market sentiment. The first signs that the ground was unstable appeared subtly, but by 2019, they were impossible to ignore. The WeWork debacle served as the screaming siren. As the company prepared for its 2019 IPO, the public markets finally scrutinized the esoteric governance, the opaque related party transactions involving Adam Neumann, and the fundamental lack of profitability. The desired $47 billion valuation evaporated overnight, plummeting to less than $8 billion, forcing the IPO to be scrapped entirely. SoftBank was forced into a humiliating rescue package, injecting further billions just to keep the lights on and claw back some control, ultimately taking a massive write-down that shook investor confidence globally. This wasn't just a bad investment, It was a stark realization that Masayoshi Son's personal endorsement was not the same as sound due diligence. Following this, the initial public offerings for other vision fund darlings began to falter. In late 2019, Slack's direct listing underwhelmed, and several other high-profile portfolio companies struggled to maintain their lofty private market valuations upon hitting public exchanges. Furthermore, the reliance on Saudi PIF capital began to reveal geopolitical fragility. Following the assassination of journalist Jamal Khashoggi in October 2018, there was intense international scrutiny on the Gulf Kingdom, putting pressure on Sun, who had publicly championed bin Salman as a key partner. The funding relationship, while still robust, became decidedly less comfortable for Western partners, and portfolio companies reportedly grew wary of the political entanglements associated with vision fund cash. But the true stress test arrived in March 2020, the COVID-19 pandemic. Overnight, the foundational assumptions underlying many vision fund bets, unfettered global mobility, Uber, oil rooms, massive enterprise expansion, Slack, and physical office consumption, WeWork, were fundamentally challenged or outright destroyed. Suddenly, companies reliant on sustained, rapid cash burn were facing liquidity crises. The easy access to cheap debt and later-stage funding dried up as the world retreated. Masayoshi Son, historically known for his bravado, confessed publicly in May 2020 that the fund had suffered a massive, undisclosed internal hit, reportedly losing hundreds of billions of yen, and admitted that he had been too aggressive in his deployment strategy. He famously declared that the world had entered a war footing financially and that SoftBank needed to adopt a defensive posture, conserving cash rather than deploying it. This dramatic pivot, from the unstoppable juggernaut to a besieged fortress, signaled a paradigm shift. The era of easy money and guaranteed dominance was over. The real cost of that speculative ambition was about to be revealed. Sun had proclaimed the world was entering the age of AI. Instead, the global shutdown exposed the fragility of an empire built on unsustainable growth projections. The years 2021 and 2022 were the definitive reckoning for the Vision Fund, a period where the market correction brutally stripped away the inflated expectations of the prior decade. The pivot to defense in 2020 was followed by a desperate attempt to realize gains before the tide turned completely. SoftBank rushed several key portfolio companies public in the SPAC frenzy of 2021, attempting to harvest the paper profits. Companies like Coupang, the South Korean e-commerce giant, and Auto One Group were brought to market, showing initial success. However, the valuation environment shifted violently in late 2021 as the Federal Reserve signaled an end to near-zero interest rates, tightening the flow of cheap money that had fueled the entire tech boom. For the Vision Fund, this was catastrophic. As interest rates rose, the perceived future value of unprofitable, high-growth companies plummeted. Suddenly, companies valued at $10 billion privately were worth less than half that publicly within months. The financial metrics that Sun had largely ignored, profitability, positive cash flow, debt management, became the only metrics that mattered. The losses became quantifiable, public, and staggering. In the fiscal year ending March 2023, SoftBank reported its largest ever net loss, primarily driven by the Vision Fund's underperformance. Reports indicated that the fund had booked over $30 billion in paper losses across its portfolio in just the preceding year. The depth of the exposure was vast. Stakes in companies like Klarna, the Swedish fintech unicorn, saw their valuations slashed from a peak of $45.6 billion down to less than $7 billion in subsequent funding rounds, representing billions in direct losses for SoftBank. Ride-sharing valuations softened dramatically outside of Uber. Furthermore, the geopolitical climate turned hostile for some of their crown jewels. The US government increased regulatory pressure on ByteDance, threatening a forced sale of TikTok, putting SoftBank's most successful asset under existential threat. By mid-2022, Masayoshi Son was forced into a radical liquidation strategy. SoftBank began aggressively selling off large blocks of its most liquid assets, including significant portions of its Alibaba stake, which had previously been the fund's rock-solid foundation, just to generate cash and shore up its balance sheet. These sales were a tacit admission that the 300-year plan required emergency measures. Rajiv Misra, the architect of the initial deployment strategy, reportedly departed amidst internal friction in the massive write-downs, further signaling the end of the fund's most aggressive era. The scale of the destruction was unprecedented for a venture capital entity of this magnitude. From its peak AUM, the Vision Fund reportedly shed nearly two-thirds of its paper value. The narrative shifted entirely from Sun being the genius who saw the future to Sun being the speculator who overpaid for everything. They were forced to drastically cut back the planned Vision Fund 3, opting instead to focus on nurturing the surviving assets and desperately hoping for favorable IPO conditions that never fully materialized. The relentless pursuit of disruption had culminated not in ownership of the future, but in the agonizing realization that even the world's largest checkbook cannot indefinitely defy the laws of economics. The question now wasn't who they would acquire next, but which current holdings they would be forced to jettison simply to survive the next quarter. Today, the SoftBank Vision Fund exists in a state of perpetual triage. The era of growth at any cost is definitively over. Masayoshi Son has publicly adopted a far more cautious, almost conservative, tone, emphasizing profitability and sustainable unit economics over futuristic potential. The aggressive investment spree has been replaced by a rigorous process of portfolio management, which often means selling stakes at a loss or refusing to participate in down rounds. A stark contrast to the era when SoftBank would swoop in to save struggling startups with massive cash infusions. The lasting impact of the Vision Fund saga extends far beyond SoftBank's balance sheet. It fundamentally reset the expectations across the entire global venture capital ecosystem. Founders now face tougher questions about their path to profitability, and investors are far more skeptical of valuations based purely on future TAM, total addressable market, figures disconnected from near-term revenue. The Vision Fund proved that even infinite capital cannot indefinitely suspend financial reality when global macroeconomic conditions tighten. The lesson learned, however painfully, is that technological disruption does not exempt companies from the need for sound business fundamentals. For SoftBank, the recovery hinges significantly on the performance of its remaining crown jewels, most notably the continued success of ARM Holdings, which SoftBank attempted to take public again, and the stable performance of its existing stake in ByteDance, despite the persistent regulatory overhang. Masayoshi Son remains at the helm, but the aura of the infallible visionary has been tarnished by the staggering $60 billion in cumulative losses reported across the main Vision Fund entities. He is now tasked with rebuilding trust with his limited partners and proving that SoftBank can be a judicious investor, not just a reckless spender. The myth of the unstoppable capital machine has been shattered, leaving behind a sober reminder that in the world of finance, even the grandest visions are ultimately constrained by quarterly earnings reports. The question remains: can Masayoshi Son pivot from being the disruptor to being the survivor? And what scars will this multi-billion-dollar gamble leave on the landscape of global technology funding for the next decade?